Attention to Wall Street and what's happening over there right now is the impact of 89,000 private jobs getting added for the month of September, which indicates a still tight labor market. This has spurred the bond yields to pull back from the kind of multi-year highs they've seen. But remember, Wall Street is coming off that losing session that Nisha was talking about, where the Dow Jones has lost more than 400 points, the S&P down 1.3%, and the Nasdaq down close to 2%. But as of now, Dow Jones is taking a cut of another 0.25% as we speak, and the Nasdaq is in green territory. So is the S&P 500, but only by a sliver. The Nasdaq is up around 0.6%, and the S&P 500 by about 0.1%. But we'll continue to track what's happening as far as Wall Street's concerned. But of course, there is an impact of these surging bond yields that's going to be played out in our markets. Could the bull run be stopped because of these surges we are seeing in American bond yields? And of course, the bond yields in India as well have been spiking. To get a perspective on this from Crossbridge Capital, Manish Singh is joining us from London, and Chief Market Economist Peter Cardillo is with us from Spartan Capital Securities in the US. Good evening, gentlemen. Glad you could join us. Manish Singh, to you first. We are seeing these US bond yields surge, and the 30-year yields have spiked to 5% for the first time since the year 2007. And the dollar naturally has become stronger in the bargain. Can you explain to us what's driving this American bond yield surge and what implications it may have for investors in India, where bond yields have been spiking as well?
Sure. So two things to bear in mind. First is the inflation talk that we've had for some time. So if you look at the core PCE, and this is Fed's favored measure to look at inflation, those numbers are coming down. So on a 1 month, 3 month basis, annualized rate is around 2%, 1.8 and 2.2% respectively. So that's good news. The second thing is that if you're looking at the long end of the curve, if you are worried about inflation, or if the market was worried about inflation, then the break-even inflation, which is basically the difference between the inflation-linked bond and real yield bond, tells you the inflation expectation, that would also move higher. It hasn't moved higher, rather it has fallen and it continues to fall. So the long end move in yield that you are seeing is not based on any inflationary or inflation fear, which just makes me believe that what you are seeing on the fiscal side, because in US it seems both the parties are committed in a bipartisan way to keep spending more money and running up higher debt, that is causing an issue with the investors. And investors are trying to tell the government that that's not the right way to go, and therefore they will not be buyer of long-dated US Treasury or long debt that US government will have to issue to meet its spending requirements. So I think that that's one message one has to bear in mind. Now, should that change, and should you have moves from the Biden White House and whoever the next president is, then or at least a discussion on that front, how budgets are going to be run in a lesser, smaller deficit and balanced budget in medium term, that could play a big role. And that is, I believe, is what's driving. Let's not forget that because the Fed is not cutting rates and the Fed has guided higher for longer, yes, and that seems to be the consensus view.
That's right. And the hawkish stance continues, Manish. Yeah. Peter Cardillo, do weigh in on this. The Fed's monetary policy decisions are often a key driver of bond yields. Now, if interest rates remain elevated and the job market remains resilient as it is right now, going ahead, how do you see the Fed stance, which is currently hawkish, influence both the short-term and the long-term bond yields?
Well, I think, the Fed will remain hawkish. And if you look at some of the comments, not recently, but let's say over the past 3-4 months, there has been no change in this Fed hawkish talk. And so they remain data dependent. Now, we've had inflation news last month that continues to indicate inflation is going in the right direction. Obviously, I'm referring to the PCE price index, where we saw overall 50-year inflation drop, and that's good news. And the Fed wants to see that. But of course, there's been contrasting macroeconomic data. Some point to weakening economic activity, while other data suggests that the economy is still in a growth mode. In fact, we saw that today with some of the data that we received. And so it's data dependent as far as the Fed is concerned. But I also believe that if we get September inflation and October inflation data that comes in weaker, and if we get a reversal in oil prices, which, by the way, they have probably reached a short-term peak. As you can see, oil prices are under severe pressure today. Then I think, while the Fed remains hawkish, their action is not likely to be what their talk is. So
right.
What I'm suggesting is that there's a possibility that the Fed has already finished in raising interest rates.
Manish, if that is the case, I don't know if you buy into this thought, but if that is indeed the case, where the Fed may not hike rates further, are we likely to see an end to the kind of foreign investments that are pulling out of emerging markets like India?
Yes, so I have been of the opinion that the rates are way too high from where it should be. So I definitely buy into that. And I think you're going to see the market surprised again that the 10-year rates are going to be lower, much lower from where it is today if you look on a 12-month basis. So I do buy. Now, the second, your question about the investments moving into emerging market and if that's going to be eased, certainly it will, because if you look at the growth stocks or high growth market, that does get impacted by bond yields, strong dollar, and those things are going to be moving in the opposite direction when the yield starts coming down. And that will impact, not least, the risk appetite that investors are going to have for assets. So those things are going to play again. One thing we have to bear in mind that September has been a negative month, which is not unusual. If you look historically, September seasonality has always been very weak, that you have a weak September month historically. Now, by the same token, seasonality for Q4 has always been very positive, and you can see this data going back even 50, 100 years. And the other seasonality to bear in mind is the third year of the US presidential cycle. That is the best year out of the 4-year of the presidential cycle. So there's lots that is helping, could act as a tailwind, seasonality and data-wise, and as we have discussed, inflation is coming down, so that could all ease things up.
Right. Peter, two commodities that are in focus. There is gold, of course, and these prices of gold, they continue to fall in the wake of this bond yield surge. In India, gold prices have fallen nearly 3% in the month of September. And now we are going deeper into festive season, followed by weddings, which is peak gold buying season in India. How do you see gold prices pan out and the impact of crude oil prices on the inflation story, both in the US and in India? That's going to be an important one to watch out for, isn't it?
Yes, it is. Gold prices have been under pressure, and that's due to the fact that we've had a very strong dollar. We have a strong dollar, and certainly yields that are continuing to move higher. And by the way, I want to clarify something on the yields. As I said before, the Fed, in my opinion, might be over with raising interest rates, but that doesn't mean that we're not going to see high levels of yields throughout 2024. So that is a problem for the markets. But, like I said, gold has been under pressure. And from a technical perspective, it's obviously in a near-term downward trend. So there's a good chance that either we hover around present levels or we work our way a little bit lower. But a lot of that depends on what happens over the next month or so with the greenback and, of course, with yields.
Absolutely. And Manish, even as we look at both gold and crude oil right now, the RBI policy meeting is coming amidst this environment, this sell-off that we're seeing in bond markets, the spike in yields, the FII selling, and the rupee now hovering near its all-time low against the dollar. With these rising crude oil prices, all of these raising concerns over high inflation. What do you think would be prudent for the RBI to do with their interest rates, in your opinion?
Well, I mean, in many cases, in many ways, all the central banks in the world are a bit on the receiving end of U.S. policy. So my view will be that one doesn't have to take any knee-jerk reaction, which could make things worse. My personal view is that U.S. has finished raising rates. And the data is indicating that while things are looking good on surface, a lot of things, if you look at the housing data in US, doesn't look pretty very good. So if one has to have the patience to see through some of the short-term walls, which I'm sure RBI will take into account before they make a policy decision, because they're not making that decision for a month, but they're looking at medium term to see where the rates are going to be. And I would expect that the RBI is going to see this through, because there's as much you can do from monetary policy point. Fiscal policy becomes a big driver on that front. I think that India is in a good position. And high oil prices, again, we are receiving in India, we are receiving end of high oil prices. All you can do is run more responsible fiscal policy, which could constrain growth in the short term. But there is no other option. There's no other way out of that unless the dollar starts weakening and energy price starts coming down.
Consolidation is something that we've set our targets on, and how much further we are able to push that, despite the fact that we are going into election mode now in 2024 here in India. We'll continue to monitor all these moving pieces, but thanks very much, Peter and Manish, for joining us with your perspective on this edition of India Tonight. Great to have you with us. Meanwhile,